Hello and welcome to a new episode of Dividend Data. My name is Zach, and I was just looking at some of the stocks reporting earnings this week, and I noticed that yesterday, Nordson, ticker symbol NDSN, is down nearly 9% after reporting earnings. This company is a dividend aristocrat, meaning they have over 25 years of consecutive dividend increases. Their most recent increase was 14.71%. So I thought it would be a good idea to do an updated stock analysis on Nordson and decide whether this 9% sell-off is a buying opportunity. But we also had some other interesting earning news from the week, such as Adobe selling off nearly 13% after their earnings. Adobe is not yet a dividend payer, but this is a fast-growing software company with reliable subscription revenue, and it generates a lot of profits. So yes, this isn't a dividend stock, but I will still cover it briefly because it is a great business. But there were also two great dividend growth stocks that reported on Monday, Oracle and a lesser known one, CASY Store. This is a very high quality dividend growth stock and may be worth adding to your portfolio. So we've got a packed schedule today for stock analysis, and I may even be back tomorrow to discuss the upcoming earnings for both Broadcom and Costco. With that said, let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. And throughout, I will be using my stock research tool over on dividenddata.com. And by the way, if you wanted to try it out, we now have an exclusive offer for first-time customers where you can get your first 3 months at the cost of one. This is a great time to join. You can use our AI analyst, which I'm going to use briefly throughout the video, plus our full stock analysis tool and portfolio tracking. Link in the description and pinned comment of the video. All right, so first let's go with Nordson, ticker symbol NDSN. They reported their earnings after market close on Wednesday, and they actually beat expectations on both revenue and earnings per share, but the stock is down nearly 9%. So let's try and understand why the stock could be down and what they reported in their earnings. And then I'll come back and give a full picture look at Nordson stock and explain why it's been such a great dividend growth stock over time. Using the Dividend Data AI analyst, you can summarize any quarterly report and earnings call right after it happens. So we can see that for Q4 2024, sales were up 4% year over year, and 6% of that growth was driven from a new acquisition, Atrium. Operating profit was at $205 million for the quarter, which is a 30 basis point increase year over year, and that was due to improvements in gross margin. EBITDA is up 6% year over year. And if we look at performance by segment, you can start to get a little bit of the picture for why maybe the stock is down. The company operates in 3 business segments: Industrial Precision Solutions, which is over 56.2% of their revenue over the trailing 12 months. That's followed by Medical and Fluid Solutions, which is 24.9% of their revenue, and Advanced Technology Solutions, which is 18.9% of the revenue. So if we look at performance by segment, you can see that their largest business segment, Industrial Precision Solutions, saw a 3% decline in sales year over year. So it's never really a good thing when your biggest business is declining, and that could be reason enough for why the stock is down. However, their other business segments are growing fast. Their second largest, Medical and Fluid Solutions, saw 19% revenue growth year over year, and Advanced Technology Solutions saw 5% growth. The other negative for the report was that for fiscal 2025 outlook, they expected sales growth of 2 to 7% and anywhere from flat to 8% growth in adjusted earnings per share. So this is a broad range and is no doubt on the conservative end of where analysts were likely expecting Nordson stock to be. So given that soft guidance, it makes a little more sense why the stock may be down nearly 9%. But if they hit the upper end of that guidance, then this may prove to be a great buying opportunity for Nordson stock. The price is now at $227 per share, which is the lowest since this July and lowest since fall 2023. And this is a company that has continued growing over time. You can see their earnings per share continue to increase. Revenue per share is growing at a 5.8% 10-year compound annual growth rate. Free cash flow per share is growing at 8.39% 10-year compound annual growth rate. They have increasing shareholder equity, but net debt is also at its all-time high of $2 billion, likely due to the acquisition they just mentioned in their earnings summary. But to be fair, this is a company that generates consistent and growing free cash flow. But let's remember, Nordson is a dividend aristocrat. They have over 25 years of consecutive annual dividend increases. The 10-year compound annual growth rate of that dividend is 13.49%. The 3-year CAGR is 15.21%, and the most recent dividend increase was 14.71%. This is a very sustainable dividend too, with a free cash flow payout ratio of 32% and a net income payout ratio of 34%. And Nordson is normally a very low yielding stock, but now their dividend yield is up to 1.37% after the recent sell-off. That makes it the highest starting dividend yield over the past 5 years, excluding the coronavirus pandemic. And over the past 10 years, it's the highest since 2015 through 2016. This is a strong dividend growth company with a total return of 235% over the past 10 years. That's after this recent sell-off. And since 1990, the stock has a total return of 2,800%. So if you want to add this dividend aristocrat to your portfolio, now may be an interesting time to start looking. Another company which just reported earnings on Wednesday was Adobe, ticker symbol ADBE, and that is a 13% sell-off after earnings. And I am really wondering why that could be. If you look over here at their earnings chart, it is insane growth over the past decade, and that growth only seems to be continuing. So this may be a crazy buying opportunity for a fast-growing software stock. If we look at their earnings, they beat analyst expectations on both revenue and earnings per share, and their earnings report had a lot of positives. Revenue was up 11% year over year. Earnings per share grew 17% year over year. And in my opinion, most importantly, free cash flow for Q4 2024 was $2.873 billion, which is 85.35% growth from Q4 2023. So free cash flow is definitely strong at Adobe. Q1 2024, they had very weak free cash flow, only at $1.1 billion. But now we are back up to all-time highs in quarterly free cash flow. And at least what I was expecting with Adobe, the guidance for fiscal 2025 was pretty good. They're targeting revenue of $23.3 to $23.55 billion for the year. That would be up from $25.5 billion in fiscal 2024. So that's about 8 to 9% growth in revenue year over year. So I guess that is a slight deceleration from the 11% year over year growth. But personally, I think Adobe has a lot of positive momentum behind it with all the new AI advancements. So I would not be surprised if they beat these revenue estimates. They're also expecting non-GAAP EPS of $20.20 to $20.50. That is very strong growth on the earnings front. In general, I would use this sell-off as a potential buying opportunity for Adobe stock. I do think they're poised to benefit a lot over the coming 5 years, and they have a great core business model that will continue to grow over time. So yes, not a dividend stock, but this is a high-quality growth stock. Revenue per share is growing at a 19.17% 10-year compound annual growth rate. The 3-year CAGR is 13.28%. Free cash flow per share is growing at a 22.97% 10-year CAGR. The 3-year CAGR is 11.24%. The company has a very strong cash position. However, they do not pay a dividend. I think it would be interesting if they became a dividend payer, similar to how Salesforce and Alphabet and Meta have become dividend payers in recent years. They do repurchase shares though, 1.96% over the past year. Adobe is a stock I've been considering in my non-dividend portfolios. The 10-year total return for Adobe stock is 527.33%, which is a 20.1% compound annual growth rate. And since 1990, this stock has had just ridiculous returns at a 40,000% total return. That's an 18.7% compound annual growth rate. Adobe is a stock I've had on my watch list for a long time, and it is the biggest sell-off on that watch list today. So I got my eye on that one. And then I'll cover 2 quick earnings news from earlier in the week. CASY General Store, ticker symbol CASY. They reported earnings on Monday after close. They missed on revenue by 1.82%, but beat on EPS by 13.58%. This is a company I have no real life experience with, but the stock has started to get on my radar in the past year, and that's because of its great performance. You can see that the stock price has just boomed, but that's been backed up by continued earnings per share growth. This company generates a lot of free cash flow, and they're on pace for one of their highest years of free cash flow in this coming fiscal year, and a lot of that cash has been going back to shareholders. They have a $2 annual dividend per share, which is a quite low dividend yield given their strong stock price performance. That's down to 0.47%. The payout ratio based on free cash flow is 16.96%, and based on EPS is 12.53%. So an extremely low payout ratio with a lot of room to continue growing the dividend payment over time. 10-year CAGR of the dividend is 9.6%, 3-year CAGR is 12.62%, and the most recent dividend increase was 16.28%. So now might not be a great buying opportunity for Casey's General Stores, but it is definitely something to have on your radar and know that it's a high quality dividend growth stock. Also Monday, we had Oracle, ticker symbol ORCL, and they missed on revenue and earnings per share. So Oracle stock actually saw a pretty significant sell-off, but it is overall still in that all-time high range. They had a crazy past 2 years really since the AI wave came out, and that enhances a lot of their existing business units they were already operating in. In general though, Oracle has been a dividend growth stock. However, they do have an interesting pattern where they increase every 2 years, not every year, but those are larger. For example, their most recent increase was 25%, and I would expect based on their recent performance, it would be another 25% increase soon. The payout ratio based on free cash flow is 37% and 41% based on earnings per share. If you don't own Oracle stock, it may still be a little too expensive to start buying in, but I would be interested in doing a full stock analysis on this, given that they are poised for high growth in the future, at least according to analysts. For my own purposes, I wouldn't mind researching their business model a little more. But anyway, that's a quick little stock analysis for you guys today. Thank you for watching, and please subscribe to the channel if you enjoyed the video. Leave a like and comment below. And if you want to use the stock research tool I showed throughout, then sign up at dividenddata.com. If you're a new member, you can get your first 3 months at the cost of 1. That gives you the AI analyst, the stock analysis tool, and the ability to track your watch list and portfolio. Thanks for watching, and I'll see you in the next video.